Hi, Professor, and my dear friends. Today I am before you to discuss about the adjusting entries and the actions taken to improve the financial forecasting. Introduction. An adjusting journal entry refers to an entry made in a company's general ledger after the conclusion of an accounting period to document any unacknowledged revenue or cost incurred during the time. A financial forecast is conceptual framework that provides estimations of historical, present, and anticipated financial circumstances. Both organizations and individuals can benefit greatly from the practice of financial forecasting. Anticipating the future path of economy involves an examination of historical trends and the formulation of inferences on forthcoming developments. Financial forecasting is prevalent practice employed by businesses to establish budgetary allocations, inform investment choices, and strategize for expansion. Inventory transactions and the costs of goods sold. Inventory transactions refer to the exchange of products inside a company's operations, encompassing both the procurement and the sale of items that contribute to the generation of income. The cost of goods sold refers to the expenses incurred by corporation in relation to the inventory items that are sold to clients. The recording and management of inventory transactions are of critical importance since they immediately impact the cost of goods sold. The cost of items sold or the cost of goods sold represents the specific cost directly associated with the production of procurement of items that a firm subsequently sells over a certain time frame. In order to have a deeper understanding of a relationship between the material costs and the cost of the product sold, it is imperative to examine the mechanisms involved in tracking material costs. According to our presentation, journal entry example here I taken is we purchase inventory worth $1,000 on credit. The general entry would be like this. And then considering the T account example, the T account for inventory would show the increase in inventory due to the purchase of the $1,000 worth of inventory. Adjusting journal entry. An adjusting entry refers to a journal entry that is produced after the conclusion of an accounting period in order to document a transaction that has taken place but has not yet been documented. In this particular instance, it is imperative to make an adjustment as there exists a discrepancy between the inventory count and the corresponding reported amount in the financial records. The impact of an inventory counts adjusting entry on past forecast is significant in two key concepts: the cost of goods sold and its effects on accuracy of the financial statements. Journal entry example here. In this example, the inventory cost relieved that we have is $900 worth of the inventory on hand instead of recorded $1,000. The general entry would be like this. The cost of goods sold is $1,100. Inventory is $100. T account example. The account for inventory would show a decrease of $100 in the inventory due to the adjustment, and the T account for the cost of goods sold would show an increase of $100. Avoiding forecasting error in the future. By using effective inventory management techniques, forecasting errors may be prevented. Enhancing the precision of reported inventory levels may be achieved via utilization of advanced inventory management systems and the implementation of periodic physical inventory counts. Enhancing inventory precision and mitigating the likelihood of inconsistencies may be achieved by using the just-in-time inventory techniques and employing technical tools such as barcoding. It is advisable for businesses to have a systematic process to periodically compare their recorded inventory with physical counts. The frequency of this reconciliation process may vary depending on market conditions and the nature of the organization, with potential intervals of monthly, quarterly, or annually. The implementation of regular audits and reviews facilitates the prompt identification and resolution of issues. Conclusion. In summary, the use of adjusting entries is essential to guarantee the accuracy of financial statements and facilitate effective forecasting. The implementation of routine inventory audits Along with the utilization of predictive models on the software, there can be effectively mitigate the probability of flaws in forecasting. Thank you. Thank you once again. Thank you all.